Good evening, all the joinees. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Markets. Meanwhile, others join. Let us discuss the topic that we'll be covering today. Our today's webinar discussion will revolve around understanding rolling analysis in a detailed manner. Firstly, here we will understand what all terminologies are used on NGEN Markets to understand rolling returns in totality. Next, we will move ahead and understand how we can do these calculations in an Excel sheet with respect to a particular fund. Then we will proceed further and understand the rolling returns distribution analysis, which tells about what is the probability that a fund or a list of funds could generate returns in the client's target return range, and how you can arrive at that either on a fund level or on a list of funds, or alternatively on a portfolio level. So that is rolling returns distribution analysis. Lastly, we will see how portfolio level as well as individual fund rolling returns analysis could be interpreted. Ultimately, understanding it on a fund level will have to be extrapolated on a portfolio level as well. So once we understand individual level rolling returns analysis, the same can be extrapolated on a portfolio level. But we will see how we can check that on NGEN Markets platform. Finally, we'll throw the forum open for a Q&A session wherein you can get your questions answered by directly unmuting yourself to speak or typing in your questions in the chat box. Let us now begin. So for the purpose of our webinar today, we'll be specifically focusing on the compare section, which is the fifth tab on NGEN Markets platform. The moment we go to the compare section, what we will do first is we will try to understand rolling returns analysis on a particular fund. To do that, I'll load a fund in the compare section tab. So to load that, you typically go here at the top and let's load in, let's say, ICICI Pro Blue Chip. You choose that. The moment the fund gets added, you will then move to the rolling returns tab to do a detailed rolling returns analysis on this particular fund. We have a dedicated tab which caters to only rolling returns, right? The moment you hit on this, there will be multiple terminologies that you will see on this particular window. Let us understand these one by one. First of all, what you can see is the rolling window, which is here mentioned as 260. Rolling window is nothing but holding period under consideration. Meaning, as I said in mutual funds, right? So the longer you hold, the better is is the return that you might get either on a fund level or of course on a portfolio level, right? So typically here we express that in terms of days. 260 days is always equivalent to 1 year in terms of working days on the platform, right? So if you typically want to check it for a 5-year time period, all you will need to do is in this rolling window, you will put 260 multiplied by 5, that is 1300. Currently, we'll be keeping this constant as 260 days itself. So this typically is nothing but the holding period under consideration. Next data point that you see here is the start and end date, right? So this typically is the time horizon under consideration. That means what we are trying to do here is we are trying to calculate a rolling returns analysis, let's say in the last 10 years, right? So I choose 2014, maybe August. So that's 10 years time period. In these last 10 years, if I were to roll these returns for the particular fund under consideration every 1 year basis, then what are the average returns that this fund gives me? Basically, it means what is the consistency with which the returns of these funds are generated, right? So this is the time horizon. That means I'm going to roll returns for every 1 year time period in the last 10 years under consideration. So this is the time horizon. This is the holding period. And then I hit on run, right? So that means ICICI Pru Blue Chip Fund generates an average return of a 14% every year in the last, in any 1 year time period in the last 10 years. This is what start date and end date and these average rolling returns mean, right? Now, let's understand how have we arrived at these average, returns, or for that matter, highest, lowest, and the range, right? Let us understand these terminologies first, and of course, then we will move forward to the methodology in the statistic part, right? We are definitely going to have a look at the Excel calculations, but here, to have an intuitive analysis, I'm going to explain this on the basis of this line chart, right? Now, um, the start period that we've considered is 19th of August 2014, right? Exactly 260 days from that start date will be somewhere around August of 2015. And that is exactly what you will see on this line chart the moment you hover on the first point on this line chart. So you see the first data point is 18th of August 2015. That is exactly 260 days after our start date under consideration. If an investor would have invested exactly on 19th of August 2014 and held on to his investment for the next 260 days, that is 1 year, then the return that he would have got from this iPro blue chip fund would have been a 15.11%. Similarly, if the investor would have stayed invested somewhere around this time period, right? That's typically, one second, if you want to typically check the peak, you can try to hover here. So that's the luckiest when the investor would have gotten, when the return from this particular fund would have been 67.08%. So let's try to locate that. So if the investor would have invested exactly 260 days prior to that particular day, then the return that the investor would have generated from this particular fund would have been the highest, that's 67.08%. On the contrary, the investor would have been unluckiest if he would have invested exactly 260 days prior to a date when the return would have been negative 35.27%, right? So we are seeing that point somewhere here, right? So the investor would have been unluckiest if he would have invested exactly 260 days prior to this particular date, right? Next is the range under consideration. Now, what does range mean? It means how uncertain are the highest and the lowest returns, or basically the returns, rolling returns of this particular fund, right? So this fund can generate a return which is as high as a 65%, but it can stoop as low as a negative 35, right? So if you take a modular difference between the two, that is 67 plus 35, right? That comes to 102%. That is how the swing is of this particular fund's returns. That is what we mean by range. Next is the percentage positive return. That means if we consider that there are only two quadrants, right? One being positive quadrant, that is returns above zero, and the other being negative quadrant, that is returns below zero, we can interpret from this is that this fund gives returns in the positive quadrant 86% of the times. That is what percentage positive means. Now, if you were to typically know what is the negative percentage, right? What is the probability that this fund gives in the negative range, right? So all you need to do is you simply go down here in rolling returns distributions and make the interval right here to a zero, right? So that means the negative return is directly captured from here. So it can go as low as negative 35 and to what we will say zero, right? That typically is a negative return probability, right? So 13% of the times the fund under consideration will give returns in the negative quadrant. So if you do 100 minus 13.60, that is 86.40. That is the probability of it giving in the positive quadrant. So this is how these two are correlated. Now, let's move forward and understand methodology under consideration. To do that, we will add in a younger fund, or for that matter, a new fund in this list, so that we can understand this in a little better manner. So for that, I'll simply go here at the top. Let's add in a very recently launched fund to understand this in a little better manner. So let's say a Motilal Oswal large cap fund. Click on this, this gets added as a line item in the main list. And then the moment you click on rolling, you will see this added here. Now you will see this NA error. There's no need to worry right here. There's no malfunction that is happening with the platform. It is just saying that the rolling window under consideration here does not cover the time for which this fund has been around, right? As I mentioned, we have loaded in a younger fund, and the launch date of this particular fund is typically, if you want to typically check that, you click on that, and that's 12th of Feb 2024. That means period of 260 days has not elapsed from the time this fund has launched, right? Therefore, you can see this NA error. Now, how will you troubleshoot that? Also, you can simply hover on the question mark to actually, see that what is this error about, right? So it typically says that the minimum common time period for the data across the items that you have in this list should cover at least the youngest fund's time period, right? So therefore, what we will typically do is we will change this to a 130 period time period, right? So what is 130 days? I'm just simply dividing 260 by 2. That's 6 months under consideration with respect to working days. So I'm going to simply put in 130 days right here, and then I click on run, right? The moment I do that, you see all of this data come in, right? Because for the last 130 days, there is data for both of these funds under consideration, right? Now, for this, you will see that this is a time period that's less than a year, right? Therefore, these average returns, when the methodology is chosen as absolute or rather annualized, is always annualized to a 1 year time period. But because the return under consideration is less than a year, if we want to actually get in the exact or absolute returns that were generated by each of these funds, we need to change the methodology to a absolute, right? This brings us to the interpretation, right? If the holding period, that is the rolling window, is less than 260, then if you want to see the actual absolute returns, you should choose the methodology as absolute. On the other hand, for time period of 1 year, that's 260, absolute or annualized, whatever you keep will not make a difference, right? For time periods more than a year, that really depends on what you want to see. If the time period is 520, right, that's 2 years. If you want to see annualized return, then you will choose the methodology as annualized. However, if you want to see actual absolute cumulative returns for the last 2 years under consideration holding period, then you will choose methodology as absolute, right? So this is what the simple explanation of methodology was. So when we change this to absolute, now we are seeing that, okay, Motilal Oswal large cap funds average rolling return for the last, considering 130 days, that is 6 months time period, for the last 8 months under consideration is a 19%. If you typically hover on this particular point, right, that's if investor would have invested immediately when it launched, right, and held on it for a period of 130 days, the return that he would have generated is a 15.13, right? Held on it for 130 days, meaning when? Till 12th of August 2024, because that is when 6 months elapse with respect to working days. On the other hand, the highest he would have generated is a 21.05%. When is that? So you typically try to hover on the peak, right? The peak is somewhere here, right? So that's 20. Okay, that's Motilal Oswal right here. So we try to locate the peak. That's 21.05. Motilal Oswal is color coded by dark blue, right? So try to locate the peak here. If the investor would have invested exactly 6 months prior to 21st of August 2024, now how am I coming to that date? Which is right here, right? It is getting plotted when I hover on this particular line point. If an investor would have invested exactly 6 months prior to 21st of August 2024, he would have generated a 21.05% return from his investment into Motilal Oswal large cap. Right? Similarly, we can plot the lowest right here. 18.46%, and that's right here, 18.46%. Right? Now, let us understand how are we even arriving at these numbers that you see here, right? How is 15.13% arrived at? How is 13.80% arrived at? To understand that in a better manner, we are going to do all of these calculations on an Excel sheet. So for that, let us not complicate it a lot, and let's do this on a single fund level only. So what I'm going to do for that is I'm going to simply click on iProve Blue Chip. It will get loaded in a new tab. And I'm going to typically do this rolling returns analysis for a 3-year time period, right? Considering 1 year as the rolling window. So I'll change the start date to a 3-year time period. So that's 19th of August 2021 to 22nd of August 2024. Now, on a single fund level, where do you locate rolling returns analysis? That is right here. This is the tab for rolling returns analysis on a single fund level, right? The moment we land here, this is the rolling windows that we were speaking of in the compare section, right? This is right here. So 260, 520, and 780, these get loaded by default, but of course you can change this, right? Now let's do this analysis on and actually calculate how these numbers are coming up on this particular fund. So for that, what I'll do is I'll simply download the NAVs of this particular fund into an Excel sheet by simply clicking on this, right? So that downloads historical NAVs of this entire fund into an Excel sheet from the time period under consideration. So this is how the Excel will look like, right? So the date series gets downloaded 19th of August 2021. So of course, current, that's 22nd of August 2024. And alongside that, the historical NAVs and the returns, daily return sets, mind you, right? Now, to this, what we are simply going to do is we are going to calculate rolling returns on this now, right? So locate the first point that you see on the blue line here. Now, why blue line? Because blue line is representative of 260 days, that is 1 year rolling period. The first point that you see on this line chart is 18th of August 2022. Let us locate the NAV and the return on 18th of August 2022 and the seller reference in the Excel sheet. Just remember this date, 18th of August 2022, which is exactly 260 days from the start date. We'll go into the Excel sheet and we'll try to locate that. So that's right here. So 18th of August 2022, seller reference is 262. And returns for that particular time period is, the seller reference will be C262. Now, how do we arrive at these returns is by simply doing a summation of the daily return sets from 19th of August 2021 to 18th of August 2022. So how will you build that into an Excel sheet, right? So is equal to sum, take the first return, so that's C2, and we have to go until C262, right? The data that we get right here is a 11.92%, right? So I'll just remove extra decimals. So that's 19.92. Let's see if this matches right here. You see? So the 18th of August 2022, the rolling return is a 11.92%, and this is how it is actually derived at. So it is simply summation of the daily return sets for the time period under consideration. Okay, now if you want to extrapolate all of these, until the entire time period, it's Excel ultimately. So you simply drag this formula right there, and this is how you get the daily return sets until, of course, 28th of August 2023. That's where our series will end, because that's exactly 1 year prior to the current end date, right? Because we are currently on 23rd of August, right? So for 260 days to complete, this is where the data should end. Now let's check if the last point on the blue line chart right there is matching with this 34.38%. Simply go back to the fund analytics, try to hover on the last point right here on this blue line chart. So that's 34.38%. Now, what was our interpretation, if you remember? We said that that an investor, if he invests exactly 260 days prior to the date that you see here, prior to 22nd August 2024, then the return that he would generate from his investments would be 34.38%. And that is exactly what we are seeing on this Excel sheet. 260 days prior to 22nd of August 2024 is 25th of August 2023. If an investor would have invested on 25th of August 2023, this is the return that he would have generated, 34.38%. Right? So this is how we derive at the rolling returns on a day-to-day basis, right? Now, the statistic that you see right here, right? So average of 260-day time period is a 18.12%. How do we arrive at that? You simply take an average of this entire line chart, right? So if you typically build an average formula here, you'll get to the 18% average. So let's build that. That's 18.20, right? There would be differences of decimals, but this is typically what this is, right? This is the average of the entire line chart that you can see right here on the platform, right? Now, let's understand how do you do it for a typically 2-year time period, because you simply see 520 right here, and the return that um, can be seen beside that is of course average. We are not going to focus on average here because that's simply building a formula. You simply now turn off the blue line chart right here and you focus on the 520-day ruling. That is a 2-year time period under consideration, right? That's the black line chart here. The first point on this black line is 17th of August 2023. That is exactly 2 years from the start date that we have considered, right? So that's 17th of August 2023. Let's locate this date into an Excel sheet. 17th of August 2023. So that's right here. Seller reference will be C522. We'll go at the top. 1 second. You build the same formula. So sum starting from 19th of August, you go until C522. That's when our first period of 520 days gets complete. So you see the return is 24.53%. That was exactly matching with the with the number that we were seeing on the line chart. So that's 24.54%. Now, mind you, this is an absolute return because this is entire time period of 520 days. Cumulative return for last 2 years. Now, if you change the methodology to annualized, this is going to change, right? Now, let's see what is the annualized 2-year return. So that's 12.27% for the same time period. Now, how will you arrive at that? Plain simple mathematics, you simply go here, you divide this by the year factor that we use. Now, what is the year factor, right? So that is typically if 1 year is equivalent to 260 divided by 260, that's 1. 2 years will be equivalent to, change that to days. So that's 520 divided by 260. That's the year factor of 2, right? So you simply divide this by the year factor used. So that's 2 right here, and you hit OK. So that's 12.27%, and that is how you get it on NGEN Markets, right? It's 12.27%. So this is how you can play around with the data with annualized as well as absolute. Now let's go back to NGEN Markets platform. Here, in statistics, we have discussed the simple return. How do you calculate the simple returns? Always, when you open a single fund, the rolling returns analysis will always be with a statistic simple only. There is another methodology with which you can calculate rolling returns, which is point to point. The moment you change it to point, there will be different returns, and you can definitely check that. So to check that, let's simply remove this fund. We'll go to rolling again. We'll build the time period under consideration. So that's 260. We are considering 3 years, right? So 2021, August 19th, and the end date is of course set because it's 260 annualized or absolute doesn't really matter. But now, when you do simple returns, the first point is 11.92, and this is what we matched on the Excel sheet as well, right? This is what we matched. There is another statistic which is point to point. The moment you change this point to point, you will see a different number here. We arrive at 12.74. Now, how is this arrived at, right? So for that, to calculate that, we'll have to, there's a small change in the formula, because point to point considers the start price and the end price, meaning the start NAV and the end NAV only, and divides that by, typically to get into, rather convert that into percentage, divides that by the end price, right? So we'll build that formula right here. So you go to the Excel sheet back again. Our cell reference was C262. That remains exactly the same. The formula, however, will change. So we'll say, okay, is equal to end price, meaning the end return, right? So that's B, because our NAV are plotted in the cell reference B. So that's B262 divided by the start price was what? 19th of August 2021 price. That's B2, right? That's 61.22. So how will you, cell reference that? So that's B2. And you'll simply say -1. Convert that into a percentage terms. This is how we arrive at the point-to-point statistic. The difference is only in the formula, right? So typically you consider the start price and the end NAV only, and you divide that by 1, and that's how you get the formula for point to point. However, please note, everywhere on the platform, when you open single fund analytics or even portfolio analytics, you will always see simple returns, rolling returns calculated using simple returns as the statistic. Now, once we're through with the Excel calculations, let's go back to understand rolling return distributions. So we'll come back to NGEN Markets platform. Now let's consider a list of large cap funds. So how will you take the list of large cap funds? So let's go to the funds tab. The moment you click on funds tab, 4 parameters will open up, right? 4 buckets: equity, debt, hybrid, and others. We are considering all the large cap funds. So you choose large cap, you hit close. A list of all the 33 large cap funds open up. Let's consider only those funds who have been around for a 5 years or older time period. Minimum AUM, let's say 2,500, and you hit apply. Now we get a list of 12 funds. You simply add top 50 to compare. A list of all these 12 funds will get loaded into the compare section. Once they get loaded, you simply go to rolling returns. Now, what we are focusing on is the rolling returns distribution. So what you see right here are 5 buckets, right? This is bucket number 1. This is bucket number 2, 3, 4, and 5. This typically tells you what is the probability of each of these funds to generate return in the return period under consideration. By default, what it will load as the first intervals starting bucket, or the lower interval, is the lowest return. So that is as low as a negative 38.03. That will be loaded by default, right? So this gets set. What is the last interval's upper interval? That will be always fixed. Now that has been arrived by considering the highest return clocked in by the funds under consideration. So that's SBI Blue Chip, and the highest return is a 94.86%. That is how this has gotten calculated. To arrive at these intervals, what NGEN Markets will typically do is we can simulate that onto a calculator. It's simply, it will consider 5 buckets under consideration. So what we will do is we'll just load in a calculator quickly. Right. So we'll consider 38.03, which is the lowest. Add the uppermost interval. That's 94.86. That's the uppermost interval right here. Plus 94.86. So that's 132.89. This is the entire range of returns in which the returns of all of these funds have gotten plotted somewhere or the other. Right? There is not a single return which is below negative 38. There's neither a return which is above 94. Right? In this time period under consideration. So it will divide this by 5. Why 5? Because there are 5 buckets under consideration: 1, 2, 3, 4, and 5. We arrive at a size of every return interval as 26. That means every interval that you see here will have a size of 26%. That means every single interval will be of 26% each. The first interval has started from negative 38. If you add 26 to that, that comes to a negative 11. That is how the first interval is built. Second, of course, will start from the upper end of the of the previous interval. So that's 11.46 to negative 11.46. You will add 26%. That comes to a 15.26, and so on and so forth. Right? This is how these intervals are built. Now, the beauty is you can customize this. First of all, I'll just explain how these are arrived by default. So these are not arbitrary numbers. There's a calculation that goes below that, right? Now, let's say you're catering to a client which comes to you and says, okay, I want a list of large cap funds which generate, or rather, let's say my target return range is to generate a return between, let's say, 20% to, let's say, a 45%. That is my target return range. Suggest me, or rather tell me, those funds which would be a best fit considering my target interval. So what will you do is you'll come to rolling returns distributions. You will put in his target return range in either of these intervals, because all of these are editable, right? So let's change this to build it as per his scenario. So his target return range was 20% to a 45%. And you click outside. The moment you do that, there will be probabilities that will get generated of this interval, right? You simply take that into an Excel sheet, and you typically, this is how it gets downloaded, right? So this was the interval under consideration. This is the interval that we are going to consider, right? So you simply apply some filters and conditional formattings. So that means if his target return range is to generate a return between 20 and a 45%, what he should consider, right? Or rather, which fund he should be considering is Axis Blue Chip Fund. Now, of course, this is given the fact that all other factors are seen, right? That means if his holding period under consideration is 260 days, right? That is why we have chosen rolling window as 260 between 2010 to 2024. If this is what is the data, then he should go ahead and invest into Axis large cap fund, because that is the fund that has the highest probability of generating returns in his target return range of 20 to 45%. And you can build is as per entire time series. So let's say you can build negative 38 to 0, then 0 to, let's say, 19%, 20 to 45, and so on, right? It can you can practically build a series right here. This is how rolling returns distributions work. Now let's go back. Typically now, what we'll discuss is portfolio level rollings. So that's not going to be very different from what we've understood until now, but just that until now we did it on a list of funds or on a single fund level. There is also option to check rolling returns analysis on a portfolio level. Of course, we are not going to go into calculations on an Excel sheet because the logic and the formulas are going to remain exactly the same. But I'll just show you how you can locate that and where you can find that and how we can interpret that. So let's go to the portfolio section, and I'm going to load in a portfolio right here. Right. So this is a portfolio of some 5 schemes. These are their weightages, and let's consider a 5-year time period. When we consider 5 years, so that's 2019 onwards to 2024. And this is where we'll find rolling returns analysis, right? Here is where you'll see the rolling return windows, right? So let's say that's 1 year, 260, 2 years, 520. And let's say you want to check it for a 4-year time period. So we'll simply edit the rolling window, and 4 years will be 260 multiplied by 4. That's 1040. Right? So simply type 1040 here and you say run. Look at that. So as I said, in mutual fund portfolios, right, as your holding period increases from a 1 year to ultimately a 2 year and let's say a 4-year time period, the lowest return that your portfolio generates also improves. And that is exactly what you can see right now also. If an investor holds on to this particular portfolio for a 1 year time period, that's 260 days, the lowest return that he would get from his portfolio is not even 1%, right? That's lowest return, of course, right? However, as he holds on to it for a longer time period, right, when its holding period increases to a 520 days time period, that's 2 years, lowest return also becomes a 11.28%, and that is on an annualized basis, right? Similarly, if it increases to a 4 year time period, this is how we can pitch. Your lowest return will also be a positive 19.45%. Right? This is how you can use rolling returns analysis to convince clients, or for that matter, pitch clients to stay invested in mutual fund portfolios for a longer time period. Right? Because ultimately it speaks about how consistent are the returns of either a fund or a portfolio on a whole. Similarly, when we are doing this on a portfolio level, what you could also do is you can build in those ranges right here, right? The way we saw in the compare section, you can build it right here as well to actually come up with a probability with which the portfolio that you're pitching to the client meets the client's target return range as per his expectation, right? So you can simply build in scenarios here, and you can say, okay, what is the probability that your portfolio will give returns between, let's say, 12% and 24%? So that's 25% probability. So this is how you can effectively use rolling returns analysis. And that brings us towards an end of the topic related discussion. If there are any questions, please go ahead. The forum is now open for a Q&A session.
Okay, this is Rajshekar here. See, in the starting, you showed for a fund how to download the NAV, daily NAV.
Yes.
Uh, can this be done for an index also? I mean, of course, there's no NAV there, but index value will be there. Is
Yes.
that
So typically, you can do that for an index for whatever appears right here in the markets tab, right? So you go in the markets tab, whatever indices you can see in the markets tab, you could download the prices of those indices. So for example, right now, Nifty 50 is plotted, right? Right. I want historical prices of Nifty 50, let's say for the last 10 years. So you'd say 2014, let's say August, and then you click on this export indices into CSV. The
okay?
moment you do that, again, the price series of the index will get downloaded. 1 second. Yeah. So this is how it will look. I hope my Excel is visible to you.
Yeah.
Yeah. So, however, this can only be done for whatever indices you can see on NGEN Markets section only, as of now at least. So you can see some sectoral indices, you can see BSE sectoral indices, a
Yeah,
broad.
hi. This is Arnav. Just a quick one. We are actually currently working on a way where you can add the other indices which you usually find in the compare section or the benchmark section, which don't appear here. We are looking for ways to give you the ability to add those indices to this chart as well. And once you have that, you will be able to download the other indices as well. So that should be coming soon.
Okay. All right. Yeah. Yeah, that will be helpful. Yes. Yeah. Thank you.
There's a question in the chat box which says, in direct schemes, is there any way we can check rolling returns for windows of 10 years that also shows COVID impact? Since direct funds were started in 2013, it shows directly data from 2013 to 2023 when we select rolling window of 2600 days. Right. So, okay. So typically, load direct funds here, right? So for example, 1 second. Let's say a Parag Parekh. right? So this is how you load direct funds. Then you go to rolling returns, and here you will set the start date and end date, to the required time period. So let's say you said 10 years, right? So 2014, 1st of August to 22nd of August. And what you should be playing with is the rolling window, right? So if you choose rolling window also 2600, that's typically 10 years, you'll get very few data points. Why? Because this is the holding period. Once you've set the start date and end date as 10 years, then you can check it for any time period from one or other, from 1 day to typically 10 years, right? So if let's say you want to do this for every 1 year holding period, you put 260 and you hit run. I hope I've got your question correctly. If not, please let me know. But the time horizon has to be put right here. So start date and end date.
Anyway, that was not my question, but the way you showed here, those dates 2600, when you selected, it is very few points came. That is mainly because I guess it is from 1st August 2014 to 22 August. So there are at least 22 points which have completed 10 years.
Yes, exactly. So you see the first point for iPro Blue Chip Direct, what is shown as is 19th of July 2024, right? That is when 10 years have been completed from the start period under consideration. So our start period was what? 1st of August 2014. 10 years from that will be 19th of July 2024, of course, considering working days only, right?
Correct.
So 2600 exactly days,
Yeah, right. All
right?
right.
So there are only few, I mean, just 1 month data points, right? 19th July to whatever, current 22nd of August.
Right. Until the others ask a question, I see the way you are showing there, as soon as you put that download, you get all the data in Excel sheet. But it doesn't happen to me. When I do that, it goes to some CSV file. I will have to do manually cut and paste into that. So how do you do that?
Yes, sir. A CSV file can just be opened in Excel. It's really no different. It's just a basic data file with no formatting. So if you when you get that CSV file downloaded, you just open that file in Excel. So you see that .csv that Prajakta is clicking right now. That will just open in a regular Excel. You don't have to convert anything.
No, but it just doesn't. Doesn't open like that. It just it's like some plain text type of stuff. It will come. What I do is I just select the cells I want and then copy paste in Excel.
It just means that you have to set your computer to recognize CSV as a file that needs to be opened with Excel. It must be opening in a notepad or something like that. So if you try to go to Excel and open the file from there, that will work. Or else you can actually set your computer to open CSV in Excel, which generally should be the case anyway.
So where do we set that?
So that depends on your specific computer, what you're using. So we can, we can try to contact you separately and show you. But I mean, even if you just want to check, all you have to do is open up Excel first, and then go to File, Open, and then load the CSV file from the Downloads folder. So here you just go to File, Open, and File, Open, and then here you basically browse on the left here.
Okay.
Yeah. Okay. And you browse the CSV file, it will open in Excel.
Okay.
Yeah. All right, there's another question in the chat box which says, which asks a clarification. If the data is less than 1 year, we need to select absolute or annualized. So typically, if the data is less than 1 year, right, the holding window or rather rolling window that you're putting is less than 1 year. If you want to see the actual time period returns, so let's say you're putting, 21 days, that's 1 month in terms of working days. If you actually want to see 1 month absolute returns, then you will choose the methodology as absolute. If otherwise, if you want to extrapolate that to an annualized number, then you will say annualized. There's another question in the chat box which asks, what is the best method to analyze an old fund? 10 years period, 260 days rolling return. Is that correct? Arnab sir, do you want to take that?
Yeah, sure. I mean, this is mostly kind of your decision, really. There's no best method as such. The insight you will get by using a 260-day rolling return is, what kind of safety or what kind of return do you get if you hold for at least 1 year. So my suggestion, obviously, but you should think about it from your own in terms of what your clients want. But my suggestion would be use a 260-day period. If you are talking about an investment in the context of a holding period of at least 1 year, so you can, depending on the conversation you're having, you can tell your clients that in the past, if you held on to this fund for at least 260 days, generally speaking, like on these results we see right now, there are some unlucky periods where we've lost 30%, 21%. So maybe we want to increase our holding period and increase safety, because let's say you double it to 520, that will give you hopefully a smaller loss. So I wouldn't say that 260 is the best method. I think it depends on situations in terms of how long the client really wants to put money away for. If it's a really long-term investment, then you can probably plot longer periods and you can see the 780-day period, which is basically 3 years. The very small chance of losing money, and a 260-day period would probably be useful if you are worried about losses in the short term, like kind of like a 1 year period. But again, it's up to you in terms of which one you put more importance on.
Just curious to know, because you are giving that feature here, point-to-point returns for rolling also. I mean, I have not looked into it. I have always looked into simple returns because that is what most likely going to be the experience of the investor.
That's right, sir. I mean, the reason we included point to point is that a few clients also wanted to use that in some cases, especially a few of our users wanted to use point to point when explaining to clients, because sometimes what happens is if you have really volatile performance, especially like after COVID, you will get kind of quite strange numbers if you use simple returns, and strange from the perspective of just a simple understanding of returns, because you'll see if you use point to point, which is basically taking the point today and compare it to let's say in a 260-day situation 260 days ago, and nothing in between. But generally speaking, you should use simple returns. We provided that option specifically for some people that requested it. But our suggestion is, when doing rolling analysis, to always stick to simple returns, because it's the only consistent way of measuring returns over long periods of time without being affected by compounding.
Yeah. Yeah, I even didn't know. Today only I learned there is point to point also. It is, I always use the simple returns, and it was easy for me to interpret that. And so that's.
Yes, so that's why we've also made it, generally the default selection here as well.
Right. Yeah. Okay.
Any other questions, please let us know.
Yes.
Okay, if there's nothing else, we can close for today.
Yes. So thank you so much for joining in. You can definitely view the past webinar recordings on our YouTube channel, the link for which is right here onto the platform itself. Simply click on this link. You'll be taken to the NGEN Markets YouTube page, and there's a dedicated playlist that is there for webinars. You could definitely view those recordings from right here. The webinar recording for even this webinar will get uploaded by next week. Till then, do stay tuned and have a great weekend ahead. Thank you.
Thank you.